The committee will come to order. Let me invite those that are in the room to find seats best they can. Let me just say at the outset that we have a number of committee hearings that are on this morning at precisely this hour. We have Budget Director Darman up one floor in this building testifying before the Budget Committee. And there are several members of this committee, including myself, others here today on the Budget Committee, and so there necessarily will be members coming and going, attending different hearings in different settings. The Intelligence Committee is meeting at this hour, the Appropriations Committee is meeting, and several others as well. With that said, we'll accommodate members as best we can as they come and go in the course of the morning. I know, Senator D'Amato, you need to leave, I think, quite quickly, and so I'm going to just make a brief opening comment, and then I'll yield to you so that you can make your comment, and then if you must excuse yourself, that you can do so. Let me start by welcoming the Chairman of the Federal Reserve, Alan Greenspan, before us this morning. This is the first of two appearances that you'll make before this committee this week. You'll be back 2 days from now to discuss in detail your thoughts on the FSLIC savings and loan issue, and we very much look forward to that discussion and your input at that time. It'll be very important to us. For the most part, I think we ought to leave that issue aside today. There may be some questions that arise about how interest rates and monetary policy may affect the savings and loan issue, and I think that is an appropriate question if somebody wants to raise it. But generally, I would hope that we could set aside a discussion of the savings and loan FSLIC issue in any detail until you return, and we can get into it in some detail at that time. Our topic today, of course, is monetary policy. I want to say at the outset, Chairman Greenspan, that I appreciate the leadership that you've shown at the Fed in your time there. Certainly the efforts to work through the turbulent period surrounding the market break back in 1987 was a severe test of the system and all the key players, and I think your leadership during that time was a very important positive element that helped us work through that period and circumstances as well since that time. And I just want to say at the outset that I appreciate that leadership, and I believe that view is quite widely shared on this committee and through the Senate as a whole.
Well, thank you very much, Mr. Chairman.
Now, with that particular crisis having now being some year and a half behind us, the other economic problems that we have been dealing with at that time and since have not gone away. The business cycle is certainly mature at this point. We've entered the 7th year of expansion, and I think it gets harder in many ways to steer a prudent course between inflation on the one hand and a recession or a slowdown on the other. And obviously that's a very difficult set of judgments to make, and then to try to guide policy accordingly. It's clear, it seems, that the federal budget deficits and the trade deficit continue to trouble the economy and create problems for us. It seems to me that the Fed at the present time is facing a rather classic policy conflict. On the one hand, there are those who argue for tighter money to avoid an outbreak of inflation and to preserve the value of financial assets. On the other hand, there are those who argue for easier money and lower interest rates in an effort to stimulate growth and to try to increase tax receipts without raising tax rates. I'm struck by the fact that, and I will ask you about this later if you don't choose to comment on it directly, but it appears to me that your own interest rate forecasts are different than those that we are seeing in the Bush administration budget proposals, and as well the economic growth forecasts are different. And those are significant matters, it seems to me, because depending upon which set of estimates are right, obviously we face a very different set of effects and policy outcomes. And so I think we have to discuss today precisely what the Fed targets are based on and why you see them the way you do. We have, for example, with respect to growth forecasts, the administration is forecasting 3.3% in '89, 3.2% in '90. And with respect to interest rates, the administration is projecting right now, first quarter of '89, 90-day Treasury bills at 8.3, second quarter dropping to 7.8, then dropping to 7.2, the fourth quarter dropping to 6.6, the average for '89 being at 7.4, the average for 1990 next year being 5.5. That's a pretty remarkable drop in interest rates. It'd be nice if that occurs, but I'd be very interested in seeing how you today within the Fed and your colleagues forecast the interest rate pattern over that same period of time versus that forecast. I want to just make one other point today before we get into the issue of your outlook for growth, employment, exchange rates, trade deficit, and your other views on inflation and such as that. We want, in addition, your assessment of the health of the economy, both the good news and where you think the risks lie and the steps that you think we need to take. I want to just make one other point before yielding to Senator D'Amato, and that is this. I have the strong view as the new chairman of this committee that this committee ought to act, as should the Congress as a whole, when revisions are needed in banking laws and in the financial structure laws of the country. It'll be the intent of this committee to do that, to act and to act promptly and decisively as we go forward here. We've got a savings and loan problem in front of us that is an immediate problem that has to be dealt with, but it would be my expectation that we'll move on into other areas that need attention and act on those, and that I would hope that that the Fed would not feel that it has to, in a sense, step into the vacuum of an absence of congressional action in that area. I would hope that we would be able to move affirmatively within the Congress, and I think that's the way it should be done. I think we'll all be more comfortable with that, and so I hope that we can follow through in that fashion. With that, let me now yield to Senator D'Amato.
Thank you, Mr. Chairman. Mr. Chairman, in the interest of time, and I do have two other committee hearings, I'm going to ask that my statement be included in the record as if read in its entirety. I would take a moment to observe that notwithstanding the doom prognosticators, and we do have those, that the old quote from Mark Twain, I think, applies to our current U.S. economy. Rumors of its demise are greatly exaggerated. And with that, Mr. Chairman, let me congratulate you for holding this hearing and also welcome Chairman Greenspan, who is doing an outstanding job.
Thank you very much, Senator. We'll make your statement a part of the record. Senator Kassenbaum?
I have no opening statement, Mr. Chairman. Welcome to Chairman Greenspan.
Thank you. Senator Graham?
Thank you, Mr. Chairman. Chairman Greenspan, I welcome you back before the committee. I thank you for all of your good work. Mr. Chairman, I think one of the things we have to look at in terms of assessing the various projections that are made of the future is what those projections are based on. And one of the things that I will be questioning Chairman Greenspan about later today really comes down to that. Are the assumptions made by CBO and OMB realistic if you assume, as they do, that the deficit will be reduced by $55 billion? The fact that $55 billion less would be absorbed by the government if we meet the Graham-Rudman targets, meaning that money could go into the private sector to build new homes, new farms, new factories to generate new economic growth. Are the assumptions of the two budget projections realistic if you assume that the outcome of the budget debate will be such a reduction in the deficit? Secondly, I will be asking the chairman specifically, does it make a difference from your point of view in terms of trying to promote economic growth, trying to control price increases so that we don't simply repeat a cycle that we paid such a high price to break? Does it make a difference whether we deal with the deficit by raising taxes or by controlling spending? Are the two approaches to deficit reduction reduction created equally in terms of their economic impact? Or is one superior to the other from the point of view of the economic impact in trying to create growth without inflation? I think those are the questions that we've got to deal with here, and Mr. Chairman, I look forward to participating in the hearing like you. I've got to run upstairs to the Budget Committee. Thank goodness we're here doing all of this important work, lest it might not get done.
Well, try not to be gone too long. Senator Hines?
Mr. Chairman, I simply want to join in welcoming Alan Greenspan back to this committee and to commend him for the usual excellent job he has done. One of the questions that I will want Chairman Greenspan to address is the question not only of, as posed by Phil Graham, about the effect of lowering the budget deficit and how it will help make the economic assumptions or projections in the President's budget come true, but also how those projections can come true unless we address the issues that affect real growth in the U.S. economy. I refer to labor productivity, the competence and technological ability of management, and most importantly, the cost of capital as it affects productive enterprise in this country. And it seems to me that unless we really focus on the three main inputs that drive real productivity, and some of them are very hard to influence. Labor productivity is influenced by educational levels and I suppose by incentives or morale or motivation. Certainly is in the latter case true in the Japanese model. The competence or ability of management is pretty hard to influence in the short term. And I will be interested in Chairman Greenspan's comments about what we can do in improving the access to and lowering the cost of capital as an important element in the equation.
Thank you very much, Senator Hines. Let me now just indicate that the monetary report, the policy report that you're submitting this morning, Dr. Greenspan, is required by law under the Full Employment and Balanced Growth Act of 1978. I know you'll be testifying as well in the House tomorrow. This is a very important transmittal document. We'll make the full document a part of the record, and I'd be very pleased now to have you give us your oral summary.
Good. Thank you, Mr. Chairman. I'd also like the full testimony to be included as part of the record as well, and I will try to foreshorten it to a certain extent. Last year was a challenging one for monetary policy. Early in the year, uncertainties remained about the impact of the October 1987 worldwide stock market break on the economic expansion and financial system. Given these risks, the Federal Reserve increased the availability of bank reserves slightly further and monitored financial and economic indicators closely for any signs that the economic expansion was faltering. Gradually, however, it became clear that the economic expansion remained well on track and that the balance of risks was shifting in the direction of higher inflation. Consequently, the Federal Open Market Committee applied increased restraint to reserve positions in a series of steps beginning in the spring of 1988 and extending to the current period. In addition, the discount rate was raised from 6 to 6.5% in August. The policy restraint led to an appreciable rise in short-term market interest rates and a moderation of money growth beginning in the spring of 1988. M2 and M3 finished the year around the middle of their 4 to 8% annual target ranges. Despite tightening money markets, longer-term interest rates have been remarkably stable. Moreover, the stock market recovered relatively steadily over the year and into 1989, and the dollar has been fairly stable since late 1987. The optimism of domestic and foreign investors evident in financial markets reflected expectations that inflation would not intensify appreciably as well as the solid performance of the economy and prospects for its continuation. Our GNP expanded by around 3.25% in 1988, adjusted for crop losses caused by the drought. This increase helped push the unemployment rate below 5.5%, its lowest level since the mid-1970s. Employment gains in 1987 and 88 were strong in nearly every major sector of the American economy, including manufacturing. Although in 1988, farmers suffered one of their worst crop losses in this century, the situation in agriculture remains fundamentally much improved from that earlier in the 1980s. However, last year's economic performance had some disappointing features. The federal budget deficit remained high and our national savings low. This contributed to a continued large current account and trade deficit. In addition, overall inflation in the area of 4 to 4.5% during 1988 was a little above the general range in which it had fluctuated in the mid-1980s. The drought boosted food prices, adding somewhat to inflation last year, but this was largely offset by a leveling off of energy prices. Prices of other consumer goods and services accelerated a bit. This acceleration is troubling, especially with inflation already at a level that would be unsatisfactory if it persisted. Although the step up in consumer inflation to date has been rather small, some signs have emerged of greater acceleration in broad measures of costs of production. Wage gains accelerated toward the end of last year. Moreover, benefits took an unusually large jump in 1988, adding to business costs, and prices of materials inputs also rose at a faster pace. On the whole, the economic expansion remains vigorous and unusually well-balanced after more than 6 years. But with the economy running close to its potential, the risks seem to be on the side of a further strengthening of price pressures. In these circumstances, the Federal Reserve remains more inclined to act in the direction of restraint than toward stimulus. The determination to resist any pickup in inflation in 1989, and especially to move over time toward price stability, shaped the committee's decisions with respect to monetary and credit ranges for 1989. The FOMC lowered the range for M2 by a full percentage point to 3 to 7% and reduced the range for M3 by a half a percentage point to 3.5 to 7.5%. The committee also lowered the monitoring range for domestic non-financial sector debt by a half a percentage point to a range of 6.5 to 10.5 percentage points. These were the ranges adopted on a tentative basis last June. We decided to retain the wider 4 percentage point ranges that were adopted in 1988. The potential for sizable and somewhat unpredictable movements in velocity requires fairly broad ranges in order to have reasonable assurance that the targets are consistent with satisfactory economic performance. In view of the rather loose relationship of the aggregates to GNP and prices that has developed in the 1980s, the committee agreed to continue its current approach to the implementation of policy, which involves monitoring a variety of economic and financial indicators, including growth of money and debt. In this regard, appropriate growth of M2 and M3 relative to their ranges will be determined in part by developments during the year. The Federal Reserve expects its policy in 1989 to support continued economic expansion while putting in place conditions for a gradual easing in the rate of inflation over time. However, the wage and price process may have developed some momentum. The central tendency of forecasts made by members of the Federal Reserve Board and presidents of Federal Reserve banks is for inflation to rise slightly in 1989. But let me stress that the current rate of inflation, let alone an increase, is not acceptable, and our policies are designed to reduce inflation in coming years. This restraint will involve containing pressures on our productive resources and thus some slowing in the underlying rate of growth of real GNP is likely in 1989. The central tendency of GNP growth forecasts for this year of board members and Reserve Bank presidents is between 2.5% and 3%, abstracting from the expected rebound from last year's drought losses. Real GNP is projected to grow at closer to a 2% rate. With demands for labor growing more in line with expansion of the labor force, the unemployment rate is expected to remain near its recent level over 1989. Maximum sustainable economic growth over time is the Federal Reserve's ultimate objective. The primary role of monetary policy in the pursuit of this goal is to foster price stability. Price stability contributes to economic efficiency in part by reducing the uncertainties that tend to inhibit investment. Also, it directs resources to productive economic activity that otherwise would tend to be diverted to mitigating the financial effects of inflation. Price stability, indeed even preventing inflation from accelerating, requires that aggregate demand be in line with potential aggregate supply. In the long run, that balance depends crucially on monetary policy. Inflation cannot persist without a supporting expansion in money and credit. Conversely, price stability requires moderate growth in money at rates below those prevailing in recent years. In the short run, demands can fall short of or run ahead of available resources. Monetary policy can assist in bringing about a better match between demand and potential supply and thereby contribute to aggregate price stability. When the economy is operating below capacity, bringing demand in line with supply can involve real GNP growth that is faster for a time than its long-run potential. But when the economy is operating essentially at capacity, monetary policy cannot force demand to expand more rapidly than potential supply without adverse consequences. Such an attempt will result in accelerating prices and wages as producers bid for scarcer and at the margin less productive labor and capital. Over time, it would result in little, if any, additional output. As a result of robust expansion in the last few years, the U.S. economy has absorbed much of its unused labor and capital resources. No one can say precisely which level of resource utilization marks the dividing line between accelerating and decelerating prices. However, the evidence in the form of direct measures of prices and wages is clear that we are now in the vicinity of that line. Thus, policies that foster more direct growth, if such growth is to be sustainable over the long run, should focus on aggregate supply. The United States could increase growth of supply by stepping up the pace of capital accumulation. Government policies can contribute to a higher rate of investment. Tax policies can help by ensuring that returns from capital are not taxed excessively or unpredictably. And fiscal policy can boost the nation's savings rate through a reduction in government dissavings. Congress should follow the Graham-Rudman-Hollings timetable and then seek a budgetary surplus by the mid-1990s, in my judgment. An improving federal budget position should have a variety of favorable effects. It can pave the way for a reduction in our external imbalance by freeing resources currently absorbed by domestic demand. By putting downward pressure on real interest rates, it can encourage domestic business capital formation and make housing more affordable. It can encourage households and businesses to focus more on the long run in economic planning. Monetary policy also has a role to play in encouraging capital formation and economic growth over time by providing a stable price environment. Although the relationship between growth of money and the economy can vary from year to year, over the long haul, there is a close relationship between money and prices. The historical evidence suggests that price stability ultimately will require somewhat slower M2 growth than we have experienced in recent years. The Federal Reserve recognizes that monetary policy over the coming year will be carried out against the backdrop of a financial system facing certain difficulties. The thrift and FSLIC situation is perhaps most pressing. The administration has proposed an extensive, workable plan for dealing with this matter. There appears to have been little, if any, effect of the S&L problem on mortgage availability and housing, thanks in part to financial innovation in the form of the mortgage-backed securities market. However, without quick and effective action, the situation could deteriorate. Developments in the corporate sector warrant close scrutiny as well. As you know, corporate equity continues to be retired at a startling rate in conjunction with LBOs and other mergers and restructurings, and has evolved issuance of a correspondingly large amount of debt. Although these restructurings often may improve economic efficiency, the higher leverage leaves these firms and potentially their creditors more vulnerable to financial difficulties in event of a downturn. The Federal Reserve and other federal regulators are instructing bank examiners to review especially carefully loans to highly leveraged firms in order to maintain a safe and sound banking system. The international economy also will command the continuing attention of policymakers around the world. Among the industrial countries, greater concern about rising inflation followed the substantial economic growth recorded last year. Meanwhile, the process of adjustment of international imbalances appears to have slowed somewhat in the second half of last year, and many developing countries continue to face serious problems of achieving sustained economic growth, fostering development, and servicing large external debts. Some have argued that these financial stresses taken together could hamstring the Federal Reserve's anti-inflationary policy. Certainly, we have to take account of the effects of our actions on all sectors of the domestic and international economy and on financial markets. At the same time, we recognize that monetary policy is not the instrument to deal with structural financial stresses and imbalances here and abroad, and that attempts to do so may even worsen these problems. Lowering interest rates in the short run through more rapid money growth against countervailing market pressures would quickly raise inflationary expectations, leading sooner to higher, not lower, interest rates. Instead, the structural financial problems require the prompt application of microeconomically oriented solutions within the supervisory, regulatory, and legal framework. Imbalances in the world economy require the continued patient application of responsible macroeconomic policies in the United States and in other industrial countries, as well as further progress in economic reforms by the developing countries. For its part, the Federal Reserve will continue to seek monetary conditions that will reduce inflation. Our major trading partners are following consistent policies in their own economies. Together, these policies should bring about a more stable financial environment and promote long-run worldwide economic growth. Relatively stable long-term nominal interest rates and flattening yield curves around the industrial world are strong evidence that savers and investors are in accord with this view. Monetary policy, at least for the moment, appears on track in the United States. The task is to keep it on track while making necessary adjustments to fiscal policy and reforms to the regulation of financial institutions. In this way, we can ensure vigorous and balanced economic conditions over the long run. Thank you very much.
Thank you very much, Chairman Greenspan. We've had Senators Mack and Worth join us, and I gather neither wish to make an opening statement at this time. Let me now begin the question period. We thank you for that oral presentation. When I take a look at your official forecast of 1989 real GNP growth, on page 3 of your document, you indicate that the central tendency that you and the other at the Federal Reserve System see is a growth rate somewhere between 2.5% and 3%. And I note that when you lay that beside outside forecasters, other forecasters, CBO is projecting 2.9. The blue chip private forecasters' consensus is 2.7, so those two would fall within the range of what you describe as the central tendency. I'm concerned, however, about the fact that the administration, for the purpose of building its economic forecast and budget plan, is assuming 89 growth of 3.3%, and that's well above and outside the central tendency range that you have indicated that you believe is the most likely. Can you give us any understanding as to what accounts for the difference here? I mean, I assume you've talked to the administration, and they obviously see it one way, and you and others see it a different way, and can you shed any light on that difference?
Yes. First, Mr. Chairman, let me indicate that the differences between the forecasts are not large in the context of the type of errors that we make over the year as forecasters from, say, the beginning of the year, which is essentially where we are. There are differences. Their productivity numbers are stronger than ours. Their GNP is somewhat stronger. I would say that ours is somewhat more probable than theirs, although we would have chosen something closer to theirs. But I think I would be doing the process of economic forecasting a disservice if I indicated that I know for sure that it is not also a reasonable forecast to assume something higher than 3%. If somebody said we will grow 5% this year, I would say that is most unlikely, or even 4%. But frankly, Mr. Chairman, I don't think that the techniques that we have to forecast are sufficiently refined to argue strongly that the administration's forecast is just outside the range of reasonableness.
Of course, you're aware, as we are, you make a strong case for reducing the federal deficit, and I agree with you 100% on that issue. If it turns out the growth falls short of the administration's forecast, then the deficit goes higher. And obviously that starts to work its way back through creating pressures on interest rates and other things. And so the issue of what is the best estimate that we can make is critical to the question of building a budget for this year.
No, I understand that, Mr. Chairman, but there is a very difficult problem that we have in this process, because by the nature of what an administration does when it brings forward a budget is to assume that the Congress will enact that budget line by line exactly as it is proposed expeditiously. If that process actually occurred, I think that there is significant justification on the part of administration to assume they would have a somewhat stronger economy, because under those conditions, inflation expectations would fall rather significantly, as would long-term interest rates. And it is quite likely that capital investment would accelerate above the path which it currently is on, and certainly above the path which we project. So there's a very difficult problem that you have. It's a chicken and egg problem.
Well,
and it's a process by which, when I was on the other side as chairman of the Council of Economic Advisors, I had difficulty with, and I think this is a difficult concept to get across.
well, let me leave that one for the moment with just this comment. Obviously, that bears importantly on how realistic the budget proposal is to start with. Obviously, if it's unrealistic in major dimension and is so seen by most experts and observers and so forth, then the notion of a growth rate that would flow from that also then becomes not very realistic. But let's take the, you don't do an interest rate forecast, and I understand why, but I think it's very important to get your judgment on the interest rate forecast that is, again, being built into the key economic assumptions that underlie the budget that we're about to construct. And when I read to you before the 90-day Treasury bill projections running as follows: for '89, first quarter 8.3, second quarter 7.8, third quarter 7.2, fourth quarter 6.6, and the first quarter of 90 being at 6%, and then the average for the full year 1990 being at 5.5%. Awfully low rates, I think, relative to what we're seeing today, and be a very startling change over a short period of time from where we find ourselves literally this minute. Are those realistic?
Well, Mr. Chairman, as I said before, implicit in the administration's forecast, as I understand it, is the expectation of a fairly expeditious passage of the budget. I think they are correct to assume a significant decline in interest rates. If that occurs, in other words, it is consistent with the approach which they are taking. I cannot comment on any of the individual numbers, but their overall conceptual notion that interest rates will fall significantly in that environment, I have a considerable amount of sympathy for.
Well, let me just ask you this, and then my time will be up for this question period. The 90-day bill rate at the moment is at what percentage figure?
It's 8.5, depending on a discounted basis.
Yeah, roughly 8.5. And we are now finishing, we're partway through the first quarter. The estimate is that by the fourth quarter, we're going to be down to 6.6. We're going to have a full 2 percentage point drop. Is that realistic? I mean, even if you take the notion, I mean, the budget's not going to be taken in total, but, you know, I don't want anybody to be misled by what kind of an interest rate environment we're going to have here and get us way off into a set of suppositions about suddenly a very favorable interest rate environment that may not come about. And you know, the Fed is certainly going to be left explaining as to why it didn't happen if it doesn't happen.
Mr. Chairman, I don't feel I can comment very specifically on individual numbers of interest rates. I'd just like to say that, just merely reiterate what I said previously, namely that the key to the interest rate outlook in the administration's forecast is rightfully targeted on the deficit. I don't think that they or we can know exactly whether it is too much or too little, and I just as soon not get involved in trying to fine-tune a forecast.
Can you just tell me the last time that that the 90-day T-bill rate was at 6%, going back in time?
I don't do. I think preliminarily we'll check. It has to go back to the late 70s.
Go back to the late 70s. So it's been a full decade since we've had a 90-day bill rate as low as 6%, which we're now projected to meet within 1 year under the administration plan. I think that's a startling projection, and one that we ought to take a closer look at. With that, let me yield to Senator Kassenbaum.
I'm sorry, Mr. Chairman. May I just, for a moment, it looks as though it temporarily got down to that level in the fall of 1986.
I take it for a very short period of time.
Well, no, actually, it carried through a good part of 1987. Unfortunately, I'm reading from a chart. Goodly part of 1987 was at that level.
At 6%.
Yes.
And so, but you don't infer from that that necessarily means that in a period of a year's time we're going to be back to 6.
Well, I'd just soon not respond to that.
I can understand why. Senator Kassenbaum.
Chairman Greenspan, do you sometimes feel like the oracle at Delphi, and the markets of the world are hanging on every comment you make here at testimony? I would like to ask, you stressed a number of times in your statement the effect of wage and price increase. And I would like to ask if you think any increase in the minimum wage would have an effect on inflationary pressures.
Well, I don't think there's any question that an increase in the minimum wage does have an effect on the overall wage structure, and to that extent, it is something which, other things equal, would contribute to inflationary forces. The decision that the Congress has to make is whether or not the advantages it perceives from that override what is clearly an element which does exaggerate the underlying cost structure of American business.
But you mentioned 3 or 4 times at least in here that this is one of the main pressures building on inflation, in which at some point I would guess then you would take that into consideration on what you would do with interest rates.
Well, I wouldn't say that we as an organization will specifically focus on the minimum wage and take actions as a consequence of that. The answer is we would not. The issue is essentially whether or not the underlying intermediate price increases, which have been going on now for quite a while, and which have not passed through into final goods prices in the consumer's price index or even into the producer's price index, with the exception of the last month. The reason why we did not get those price pass-throughs is largely that unit labor costs, that is the cost of labor per unit of output, was remarkably well behaved. That changed somewhat in a worrisome direction towards the end of last year, and that's the reason why we are particularly sensitive to the pattern of wage movements at this time as a crucial element in the underlying cost structure of American business.
Do you see it having any effect on GNP growth if the minimum wage were to be increased?
Oh, I frankly would say that within ranges which I've heard the minimum wage discussed, I would say that the effect is modest. I mean, all economists will argue, and I think quite correctly, that the direction of an increase in the minimum wage is to increase unemployment some. Probably that does mean that it slows GNP some. I don't think the numbers are huge in the ranges where one is considering this issue, but clearly the sign of the change is, I think, indisputable.
You've spoken to several times to the task of the Federal Reserve is just simply stability. And right at the end, you talk about keeping on track and reforms to the regulation of financial institutions. I'd like to have you comment a bit further on that, and do you have some specific reforms, given your comment earlier about highly leveraged firms and the impact of that on the stability of the economy at this point, going beyond just the FISLIC plan?
Well, I was referring to a large part, obviously, in the implications of depository institution changes that would occur not only with respect to addressing the FISLIC problem, but also hopefully returning, as I trust this committee will, as will the House Banking Committee, to a review of the Glass-Steagall issues. And clearly, the difficulties that we have with respect to debt coming from the LBOs, in my judgment, does require a longer-run view of the balance of incentives to take on debt relative to equity, though I would wish to amend that it is not the LBO issue per se which would push me in this direction. I think this is something which has been clearly on the agenda for quite a long period of time, and I believe at some point it would be appropriate for the Congress to address that question.
Do you think the value of the dollar should go any lower?
I think that the group of seven, the seven major industrial countries, have done an extraordinarily good job, in my judgment, in keeping the dollar and most major exchange rates relatively stable for well over a year. And I think if we can continue that process, we can contribute to underlying economic growth not only in the United States, but for the world as a whole.
And you have confidence that we can do that? Pressures won't be such that we will see a further decline?
I think that we certainly are seeking continued stability in the dollar, and I expect that to continue.
Thank you.
Senator Wirth.
Thank you, Mr. Chairman. Mr. Greenspan, thank you very much for being here again, and we appreciate your good judgment and stability at the helm of this extraordinarily important institution. Let me ask you just a little bit, if I can understand in layman's language what looks to me as if it's going on. You all are concerned about a slowly increasing set of inflationary pressures. As a consequence, what you are doing is slowly sort of calibrating the interest rate to try to dampen that down. Is that right?
I think that is correct as a historical statement.
Well, how historical as opposed to contemporary? How does that relate to your current acts?
Well, I would say, as I indicated in my testimony, it's up to the current period. I'm just didn't want to imply that.
I got it. All right. Okay. So we don't want to. I guess. If in fact we are then slowly but surely edging up in interest rates for the purposes of dampening down inflation, the question then has to be asked what the impact of increased interest rates could be on the other problems that we are trying to deal with. This committee, as you know, is consumed with the S&L crisis and how we deal with that. It is consumed with the LBO issue and all of the controversies surrounding that, and also the third world debt problems. Now, is it fair to say that increased interest rates are going to make it more difficult for us to resolve the S&L problem? I'm not criticizing in any way, let me say. I'm just trying to understand what the ledger sheet looks like, what the balance sheet looks like.
The ledger sheet says that the higher interest rates at any particular time, the more costly the resolution of these various problems are. One of the reasons why we are embarked upon the type of policy which we have embarked upon is that we are seeking to suppress inflation so that it does not create a major acceleration in interest rates. Because it's the judgment of the committee, and I think a very good judgment, that our alternatives when confronted with the type of economy we saw in 1988 was to try to suppress the inflationary pressures and keep the interest rate increases relatively moderate, or to abandon that particular policy goal and find that inflationary expectations rapidly embody themselves in long-term interest rates, driving mortgage interest rates and other interest rates up very substantially. I would suspect, and obviously it's a difficult type of retrospective analysis to make, that had we not embarked in a tightening process throughout 1988, that interest rates today would be higher, certainly higher in the long end of the market, probably even higher in the short end, and the costs to the resolution of the various different problems that we all face would be substantially higher.
The assumption is that you all can calibrate interest rates carefully enough so that you can slowly edge them up without throwing real crisis into the S&Ls beyond where we are today, or cause some of the fragility of various leverage buyouts to get real problems because of increased interest rates. That's really the assumption, and that's the balancing act that you all are in, correct?
Yes, it is what we are endeavoring to do.
I understand.
It is not easy.
Oh, that's the point that I'm making, however, is that well, let me ask the question, is there historic evidence to suggest that you can calibrate that carefully?
We certainly have got in the Federal Reserve an extraordinary information and analytical capability. We have never confronted a situation that is exactly comparable to what we are in at this particular stage. All I can
Expand
say,
on that a little bit, will you, that we've
Well,
never
we have
been in
no-
a situation like this?
we are in the 6th year of a major economic expansion with a crisis in the thrift industry which we have never seen. It's the largest financial problem that we have seen in the post-World War II period. We have got a rather significant rise in the ratio of debt to equity, which is not only LBOs, but it's been going on for quite a long period of time. It is an economic environment which, coupled with a very large trade and central government deficit, creates a set of circumstances which we cannot merely look at some historical period and say, this looked exactly like 1920X or something like that, and then evaluate how it came out. What we have to do is to try to bring what conceptual insights we have about these relationships, the extraordinary detail that we are able to draw on the economy from our 12 Federal Reserve banks and other sources. And what I must say is a really quite remarkable, technically capable Federal Reserve staff, to be able to try to devise those sets of policies which maximize our capability of bringing most of these problems to a successful landing, if one uses that term.
My time has expired. I have great respect for the staff and what we've tried to do. I think what we've really identified here, though, is that it's really a high-wire act that you're on at this point.
It is.
And that our economy essentially is on. We've never been in a situation that is potentially as unfriendly as this economic situation.
Yeah, all I will say, Senator, is that we are acutely aware of all of the various elements that are impinging on what policies we take, and hopefully we will choose over the years the series of the right paths for policy.
Well, we're hopeful, too. Thank you very much, Mr. Greenspan.
Senator Graham?
Thank you, Mr. Chairman. Chairman Greenspan, if you were a member of the United States Senate and you were deeply concerned about rising interest rates, but you weren't on any open market committee and you weren't setting monetary policy, what would you do?
That's an easy one, Senator.
I knew it was an easy one. That's why I asked you.
No, as I've said many times before, in fact, as I've said at the beginning of this testimony, I think that a significant cut in the federal budget deficit is essential to essentially resolve the type of problems which Senator Worth and I have just been discussing. It is clear to me that much of the problems that we are confronted with can be assisted in an extraordinarily positive way by a very expeditious and significant cut in the deficit. I am not one of those who believes that the process of cutting the deficit can be overdone. I don't believe that there is too large a cut that can be done, and I trust that the Congress will move with the administration in that direction.
Well, now let me ask you a question, and I'm not trying to inject you into the very difficult policy decision that Congress has to make, and that's a policy decision as to whether we want to control the growth of spending and limit the growth rate of spending to less than 3% above the level we spent last year to achieve the deficit reduction targets by controlling spending, or whether we want to raise taxes so that government spending can grow by 7 or 8 or 9%. But let me just ask you from the point of view of looking at the economy, leaving aside any political factor, but just simply looking at what would be best in terms of maximizing our chances of sustaining the economic recovery, what would minimize the impact of rising or minimize the chances that interest rates would go up enough to choke off the recovery. Given the two choices between controlling spending and raising taxes, simply from the point of view of trying to sustain a recovery that's created 19 million new jobs, which of those two approaches to deficit reduction are preferable, or is preferable?
Well, Senator, I believe I've said before this committee before, and I will certainly repeat it, that if the purpose is to get the deficit down, there is far greater success capable by focusing solely on the expenditure side in bringing the deficit down through reduced expenditures. Secondly, I would share your view that freeing private resources is more apt to create significant economic growth than endeavoring to close the deficit gap through increasing taxes.
So basically, let me go back and again pose the question and see if I can get to focus on it. I mean, you said it, but I want to hear it in terms of the question. From the point of view of sustaining recovery and creating jobs, forgetting all the politics of the decision, would we be better off to control spending or raise taxes?
Controlled spending.
Let me ask you a second question. As I look at the credit market, one of the reasons that it seems to me that deficit reduction is so critical this year is that we're getting ready to go out and borrow $50 billion as part of the savings and loan recapitalization program. And so if we meet the Graham-Rudman-Hollins targets and we reduce projected borrowing by $55 billion, that in essence what we're doing is we're simply offsetting what is already occurring in dealing with the savings and loan problem. Do you see it that way?
Not exactly, Senator, because I think that the markets already understand the size of the gap that exists, or the hole that exists in the savings and loan borrowing requirement.
So you're saying that's already reflected in current rates?
As best we can judge, it's already in the market.
So that if we came in with a $55 billion deficit reduction package, to the extent that that is not already in the market, then it would have an impact.
Yes.
As you look at the various projections that are made by CBO and OMB, how realistic is it to think that we might actually stabilize interest rates and bring rates down by the end of the year if we had a dramatic deficit reduction action?
Well, I think it's very realistic.
So you're in essence saying that when we vote on the budget, to the extent that we're voting for lower deficits, we're voting for lower interest rates?
To the extent that the markets believe that what the Congress is doing is credible, and that's an essential element in this whole equation, then inflation expectations will fall, because I think that the market has only very marginally discounted a significant decline in the budget deficit at this stage.
And finally, do you think it's important that we do it quickly to get the full impact?
Yes, Senator, I do.
Thank you, Mr. Chairman.
Mr. Greenspan, I want to just ask you one question on the follow-up to something that Senator Graham said before yielding to Senator Hines, and that's this. He took you over two of the jumps. I don't know that he took you over the last jump, and I'd like to take you over the last jump. And that is if it turns out that we're not able, the administration, the Congress together, to come up with enough deficit or spending cuts to really get the deficit down to hit the targets, because of a number of factors, the savings and loan problem, the drug war problem, the President's new initiatives on education, and so forth. And if the only way to get to the Graham-Rudman targets or to get deficit reduction is with some revenue increase, would you favor that, or do you think that has to be avoided at all costs, even if it means missing the Graham-Rudman targets?
Well, Mr. Chairman, I have said previously that if the negotiations fail, that I would favor going, as the law requires, to a sequester. The presumption that the Congress will fail in its negotiations with the administration on this issue, I'm not at this stage ready to make.
So your answer is go the sequester route, but that any talk of any increased revenue of any sort is really so counterproductive as you would see it that you don't even want to entertain the thought of it.
I would say at this particular stage that making whatever judgments I can about the structure of the negotiations and where we are moving, that short of an agreement between the administration and the Congress, I would find a sequester the next desirable step to take if we fail to get the most desirable, which would be an agreement.
Let me pass the ball to Senator Hines.
Thank you very much, Mr. Chairman. Chairman Greenspan, you are one of the best witnesses that ever comes before this committee.
Thank you very much.
It's hard to disagree with your contention that if we don't have effective anti-inflation policies, that this will cause interest rates to rise. Obviously, we want to avoid an increase in interest rates beyond where they are, and indeed, we would all like, I think, to find a way, a set of policies that would allow interest rates to decline. I say that particularly because as measured by the federal funds rate, I think we are probably at a historic high for the cost of those funds, which was, as of last Friday, 9.31%. That is probably as high a premium over inflation as there has ever been. It's about a 5%, if you will, real interest rate. Is that, to your knowledge, a historic high for the federal funds rate since World War II?
Well, first of all, Senator, let me just mention, it's the real interest rate is, of course, much lower than that, in the sense that that's the nominal interest rate. And that basically what the deficit would essentially do is to bring, a deficit reduction would bring real interest rates down. That's essentially what is crucially and importantly required.
Well, I understand that. I just wanted to get a characterization of the current federal funds rate as to whether it is as if your definition of a real interest rate is the nominal interest rate less inflation.
Inflation expectations, yes.
Isn't that so-called real interest rate at an all-time high?
No,
when
I
looked
believe...
when you're looking at the federal funds rate.
It was higher in the early part of the 1980s, I mean, depending on how one reflects it. But the total level the more important real interest rate in the context of economic activity is the long-term real interest rate, and that was higher, as best we can judge, in the early part of the 1980s. It's come down some. It's clearly still well above normal.
Why, if the only time we can remember having a real interest rate as high as the early 1980s, as we were going into a major recession, is our best previous experience with that. How is it that you feel confident that a similarly high real interest rate will not precipitate another significant recession?
Well, first of all, Senator, the real interest rate is, in the long end of the market, still well below where it was in the early part of the decade. And as a consequence of that, even though the real interest rate in the long end for mortgages and long-term instruments has come up somewhat during the past year, it really has not come up a great deal. And as a consequence, both home building and capital investment remain rather strong. And in that context, what we are seeing is an economy which is still rather robust.
It seems to me that you can't argue this question both ways. If, in fact, the federal funds rate, as you're saying, or other shorter-term interest rates are of relatively little consequence to the health of the economy, I don't understand how you can be successful in pursuing your strategy of demand management. On the other hand, if you say that the more meaningful rates are the 30-year T-bonds, which have been in the range of about 9% for the last year, year and a half, and probably longer. That I didn't bring a set of statistics that go back any further. It seems to me that the market has been saying with great consistency, the only time the market wobbled was during the Republican National Convention, got up to 9.44 on 30-year T-bonds. But that was before Bush spoke Thursday night, I want to make clear. Is that the market is saying that Fed fears about inflation are ill-founded. How do you explain that?
I'm not quite sure what the sequence is. Would you
All right, the sequence in the latter part of the question is, if the market is a good predictor of inflation, if people are unwilling to lend their money for 30 years without adequate compensation for inflation, and if the return to those people has been for the last year and a half, roughly around or even below 9%, and the only time it has moved up is as the Fed fund rate has moved up, how do you account for your fears of inflation if the market is saying those fears are overstated?
Well, I think what the market is saying, if one interprets it in that respect, is that over the longer term, inflation expectations, meaning average expected inflation over a 10 or 20 or 30-year period, has come down, and it has come down some. That says very little about the short range outlook, meaning 2-3 years. With response to the question you raised, which is, I don't want to let it slide by because you're raising a very interesting question, namely, how do we in fact contain excess economic growth if all we do is deal on the short end of the market? The answer is that in fact long-term real rates have come up some in the past year as we have tightened, and short-term real rates clearly have come up. I mean, to answer your earlier question, the real, say, adjusted 3-month Treasury bill rate in the early 80s got up to about 7%. It fell all the way back down to about 2% and is now back up to 4%. But it is clear that the 4% is high enough in real terms to suppress inventory expansion and inventory excess, which is a very crucial element in keeping the economy on a relatively stable path. It is also true that because of the general restraint and some expectation that we will stay stable, we have not had a dramatic rise in long-term real rates. We've had some, but not a sharp one. What that is saying is that it is moving up to levels which is restraining. In other words, we are getting a level of capital investment which is slowed down the rate of growth in capital investment. My impression is that if real rates were significantly lower, we would have a much stronger current capital investment environment. So that the basic thrust of Federal Reserve policy is to try to keep a sense of stability in the markets and to try to take a posture with respect to rates and specifically with respect to the growth in money and credit aggregates, which is perceived by the markets to be non-inflationary over the long term.
Mr. Chairman, I want to thank Chairman Greenspan for delving into what is one of the great oracular questions of his job, which is how do you keep the economy growing, interest rates low, keep demand down so inflation is low. And I don't envy him his job. I would only observe that the increase in long rates that has accompanied the tightening by the Fed over the last 3 or 4 months obviously will make it harder for this country to engage in productive investment. That will make it harder for us to grow and reduce the budget deficit through growth. It will make it harder for us to build the capacity to displace imports. And I think it is a very difficult and troubling question. I'm not here to judge whether your policy is a little high or a little low, but I do worry enormously about the consequences of your having to pursue, perhaps for very good reason, a policy that at the present time would be, by your own admission, would be working against our ability to improve our productivity and international competitiveness.
Well, if I may just say very quickly, Senator, that's the reason why we have argued so strenuously for a quick action on the budget question, because the simplest way to bring real long-term interest rates down is by bringing the budget deficit down significantly.
You're trying to make us an offer we can't refuse.
True enough.
Thank you. That was a very useful exchange, I think, as well for the record. Senator Graham?
Thank you, Mr. Chairman. I have an opening statement that I would like to file for the record.
Without objection.
Mr. Chairman, when you appeared on July the 13th, we talked a bit about the question of U.S. policy as it relates to third world debt, and I believe I could characterize your statement at that time as basically advocating a continuation of the policy that was then in place. The new administration has indicated a willingness to reopen the issue and has indicated that there might be some revisions to that policy. From your perspective, what do you recommend now should be any new directions in the United States leadership relative to third world, particularly Latin American debt?
Well, Senator, as a result of the President's request to review that policy, that is under review under the leadership of the Secretary of the Treasury, and we at the Federal Reserve are obviously participating and trying to be as helpful as we can in this regard. I cannot at this stage indicate precisely how the review is going to come out, but I think it's clearly going to continue to emphasize the necessity of the sound economic policies on the part of the debtor nations international economic cooperation, basically, and appropriate means of financing, and presumably with some focus on the issue of debt reduction. But the specific details will be presumably announced within a reasonably short period of time.
One of the criticisms of the debtor nations has been that the United States regulatory policy relative to its commercial banks has been less forthcoming than has been the case in some of the major European creditor countries. Do you think that is a fair characterization?
It's a very complex question because regulations are difficult to fully understand with respect to their implications in all regards. I suspect not. I think that we don't see any material problems emerging from our regulatory structure so far as the resolution of the LDC debt problem is concerned. It's not that there are not problems. We don't believe that there are of a dimension which are going to make a rather large difference if we alter them.
With the revision of, or the review of policy that's now underway that may lead to revision, what do you think should be the standards by which U.S. policy relative to third world debt should be evaluated, say, over the next 5 years? What would be the conditions within this country, within other creditor countries, and within the debtor countries in 1994 that would lead you to say we have been successful in the policy direction set and in our pursuit of those directions?
I would say, first, Senator, that the economic policies of the debtor nations brought them back to access to the financial markets on a voluntary basis. It's clear that a number of countries could, at this stage, float issues in the euro currency markets, in the euro bond markets, but they would be at interest rates which would be so high that the debtor countries would have difficulty servicing the debts. So as the first criterion of success, it would be the ability of nations in debt to be able to get into the markets for long-term or intermediate-term borrowing at rates which they could readily service. Secondly, I would see the required, as a corollary to that, as a restoration of the normal borrowing, lending relationships between the debtor nations and the international commercial banking system. If you get one, you'll clearly get the second. That obviously will create a situation in which the large block of loans on the books of the international commercial banking system would be a good deal more valuable than it is today. And finally, what we would want to see would be that some of the debtor nations which have done better than others but have been, in a sense, contaminated by the whole process, such as Colombia, for example, find that their productive efforts get fully appreciated in the marketplace.
Thank you, Mr. Chairman.
Thank you very much. Senator Mack?
Thank you. Mr. Chairman, good to see you again this morning. Delighted to have the opportunity to raise some points with you. I wanted to follow up on the suggestion that if we were to substantially or significantly reduce the size of the deficit, there would be the possibility of a fairly significant reduction in interest rates. And you indicated, I guess, that if that would be helpful, the earlier that would be done, but if we didn't do it early, your kind of second suggestion, or maybe that was said for you, is that a sequester would be helpful. And I guess what I'm wondering, if we went through this whole process and didn't come to an agreement between the executive and the legislative branch as to what kind of deficit reduction plan should be put together, and a sequester went into place, would that be sufficient to allow for the possibility of significant reductions in interest rates?
First of all, I think that we have to distinguish between the process which the markets will perceive as permanent change and those which they may not. Clearly an agreement between the administration and the Congress will carry forward not only into the fiscal 1990 budget, but also because of the follow-on effects of any agreement, it would have a leg up in 1991 and the 1992 budgets. I'm not clear to what extent a sequester will create that type of effect. It will clearly be positive.
Let me just kind of throw in a couple of thoughts there. One thing that it would do, it would obviously create a lower baseline for the following year, which would be an advantage. And number two, it would be a statement on the part of the Congress that we were willing to allow the sequester to go into effect rather than to relax the Graham-Rudman targets, which I would think, if those two things would occur, would be a fairly significant signal to the markets.
Well, I don't think there's any question that if the Graham-Rudman targets were relaxed as a means of resolving an impasse, I think the markets would view that rather negatively.
Okay, let me see if I can follow on with that. A little bit earlier, you implied that, or I think specifically said that, from your viewpoint, that the markets had already taken into consideration the cost of the FSLIC problem. What do you think the markets have done with respect to what they think we're going to do with respect to the deficit?
It's a difficult question to answer. My impression is that there is a dubiousness out there which is very difficult to measure, which is the reason why I say that should the deficit be reduced materially, that a goodly part of that, now when I say reduced, I don't mean only for fiscal 90, I mean projected out. I think a goodly part of it is unanticipated and would affect real interest rates. The problem that I think we ought to focus on, however, is to distinguish between the Graham-Rudman targets on the one hand and the actual outcomes on the other. Because the targets are for the essentially the beginning of a fiscal year, and there are no adjustments thereafter. Obviously, if one says that the target of 100 billion is met, that is not the same thing as saying that we have guaranteed that the deficit after the fact in fiscal year 1990 will be 100 billion. As I've said in other committee hearings, my impression is if the market knew for a fact that the actual, as distinct from the targeted deficit, would end up somewhere between 110 and 120 billion, after the fact, at the close of business on September the 30th, 1990, then I think the market would take that as a significant improvement, and I think that is not anticipated, and interest rates would fall from current levels as a result.
Okay. Let me switch to another area. I think that, again, in your testimony, I drew out of it an implication that we need to be addressing capital formation in this country, and I would just like for you to respond as to what impact, if any, you think would result from a reduction in the capital gains rate as proposed.
I have always been in favor of lower capital gains tax rates, and I do think that it would enhance capital investment, especially amongst the small business sector of our economy. I would not, however, be supportive of the cut if it became part of a deal to unwind what I think were very important benefits in the Tax Reform Act of 1986, namely the significant lowering of the marginal tax rates for all taxpayers. That, to me, was a very major and important event, and I would not like to see us unwind what was then an important bipartisan compromise.
Let me just, if I could, restate what I think I heard you say. In other words, you would not accept let's say, a compromise that said, well, we'll lower the capital gains rate, but we're going to offset that lowering by raising marginal rates to compensate for what everyone agreed to as what was going to be the loss of revenues as a result, which is a debatable point. So that you would not make that trade.
That is correct, Senator. I would not.
But you do believe that the capital gains rate would assist in capital formation,
Yes,
lowering of the capital gains rate?
Yes, I do.
Okay. Thank you, Mr. Chairman.
Senator Pressler?
Thank you very much, and welcome here. Following up on Senator Mack's question about capital gains, I've been trying to figure this situation out. One, I believe the President's economists say that lowering the capital gains tax rate would actually increase revenues to the government, while I think the Congressional Budget Office is about to suggest or has suggested that it would decrease revenues to the government. And let me say that I'm not arguing the point here, but what is your judgment of that question? And am I correct? Are there different
Yes, no, I think...
Are there different respected economists who reach different conclusions on that?
Yeah, estimating the revenue effects of a change in the capital tax rate, capital gains tax rate, is one of the most difficult analytical procedures that economists have to deal with so far as economic policy is concerned. And the reason is that very small changes in the degree of what we call lock-in of capital gains, people not selling assets because they don't want to pay the gain. Very small assumptions about where changes in the tax rate affect that degree of lock-in has a very large effect on revenues. And so it is perfectly conceivable that two equally competent tax revenue analysts can evaluate the President's proposal with rather dramatically different results. There is no question that the Treasury Department's estimates are credible. I mean, the assumptions are not outlandish. The problem, basically, is that it is very difficult to make those types of judgments. So I think it's a difficult call.
Yeah. As a general rule and point of discussion in layman's terms, another thing, capital gains, they say that capital gains taxes are higher. Rich people will put their monies into art and antiques and things like that, but if they're lower, they'll put them into job-creating business activities. Is that a true statement?
I think it's difficult. I think it's difficult to say. As I understand the President's proposal, he is eliminating artifacts and the like in his proposal, and is essentially directing it towards real capital investment. The impact of changes in the capital gains tax rates have been argued at extraordinary great length with respect to just the type of question you raised, Senator, for years. And I must say to you that the battle has not been won by any side of which I am aware, and is likely to continue for quite a long period of time. I think that it takes a number of years to fully evaluate what the results would be.
Okay. So you don't have a clear position on the capital gains. You'd like to see it lower, but you wouldn't want to see us tackle that if it meant opening up the tax question again at this time. So in general, your recommendation is to leave it alone at the time.
Well, no, I would like to see it lower, but not if it costs an offsetting rise in the marginal tax rates
Okay.
for individuals.
Moving to another area, again, you've covered this somewhat, but I want to focus in. I had 16 town meetings in my state last week, and I was trying to explain this, and I wasn't able to do so. Isn't the savings and loan bonds that are proposed to be issued, whether it's 30 billion or 50 billion of debt, or however we're going to handle it, that's part of our national debt, and I agree with you that I think that I consider the deficit the #1 domestic problem, and I hope I have so voted. But isn't the adding of that debt in the aggregate, from your point of view, whether we declare it's off budget or on budget or however it's handled, isn't that essentially adding to the national debt, which is doing just exactly what you don't want to see us do?
There is a difference, Senator, and I think that the crucial question is more getting the deficit down than being overly concerned about the level of outstanding public debt, either on budget or off budget, because it is essentially the net claim on savings, which is directly related to the deficit, which is crucial to why the budget deficit is so corrosive a force in the economy. The difference between the one-shot of solution to the savings and loan is that whatever it costs, it is non-repetitive. By that I mean it does not, because it affects either revenues or expenditures over the long run, affect the budget deficit materially in the year, say, 2000. Whereas anything that is done with respect, it does not, because it affects either revenues or expenditures over the long run, affect the budget deficit materially in the year, say, 2000. Whereas anything that is done with respect to changing the structure and trend of receipts or expenditures in the regular budget will affect the longer-term budget. So in that sense, it is a one-shot, that is the savings and loan financing, irrespective of how it's done, is a one-shot effect and does not materially affect the longer-term outlook for the budget deficit.
You know, I couldn't agree with you more on this budget deficit, but we've all got to work together on it. But at some point, some respected person of national economist, such as yourself, who's got the pulpit, so to speak, is going to have to outline where those cuts are going to be. The President gave his State of the Union, and in terms of an opportunity for leadership in this area, do you feel the President sufficiently addressed the budget cut issue in that speech?
Considering he was in office for so short a period of time, I thought that the Office of Management and Budget put together a rather substantial budget. Whether it is adequate for purposes of the negotiations you're currently involved in is really not for me to say. All I can tell you is that having seen how much work was put in, it was rather impressive, and the issue of whether it is adequate, I think, will be determined very shortly.
Mr. Chairman, could I ask one more?
Please do.
One more question here. Now, are agriculture and small business more sensitive to interest rate changes? Are some industries much more sensitive? I mean, I get the feeling from listening to my small businessmen that they're extremely sensitive to interest rate changes. Is that sector more sensitive or less? Do you consider that more or less sensitive to interest rate changes?
I think it's a mixed bag. I think some depends on the nature of the leverage. It depends on the nature of alternate means of financing. I think that interest rates affect both big and small business and farmers. I think it affects everybody, but it depends on the degree of leverage in any individual firm and any individual industry. And I would not want to argue that it is a significantly greater factor in small business or agriculture, with the exception that the industry-specific aspects of debt in agriculture and in some small business do make them more sensitive. But it's not basically because they are small business. The cost of capital of small business for both equity and debt is higher than for larger, basically seasoned businesses. But the cost of capital is a bigger issue for small business in general. I wouldn't say interest rates necessarily per se.
Yes, in my town meetings last week in 16 South Dakota towns, I would say that somehow keeping interest rates down was almost a bigger issue than the Farm Bill or many other things. And I know it's tied to the deficit, and I know it's tied to a lot of things, but that is really on people's minds out there, at least the people I talk to, who are mostly farmers, small businessmen, people who come to public meetings. So I'm very interested in what you have to say and what you do. Thank you, Mr. Chairman.
Thank you, Senator Presser. I just want to make an observation on your second to the last question and the chairman's response, and that is that in terms of where the cuts might be made, and I think the new administration was very ambiguous in that area, and I think Senator Presser's questions is exactly right. And when you say they haven't been here very long, in a sense they haven't, but you know, they've been here, George's been here for the last 8 years. So in fairness, if we're going to have to address this problem of deficits and cuts, you know, he's not a stranger to that issue, nor are any of the rest of us. But I'm concerned because I think there is a sidestep going on here, generally, because of the difficulty of reconciling all of the particular problems. One of the things that you've mentioned today, and we'll talk about 2 days from now when you come back, is just paying for the savings and loan problem. If we were direct about it, if it's been discounted by the markets, which I thought I heard you earlier say that it had,
That's correct.
then why shouldn't we finance it at the lowest possible cost to the taxpayer? Why shouldn't we go out and raise the amount of money we need with a direct kind of borrowing that gets the interest rate cost down to the lowest level?
Mr. Chairman, may I address that on Thursday, because I think it requires a much broader answer than I think we want to discuss today.
Well, we can take it over to that time, but I don't think that we can sort of put directly contradictory ideas on the table today and not make some effort to reconcile them. We can't say on the one hand we want to reduce the deficit and be honest about the numbers, and on the other hand use an off-budget sort of means of financing something that the market already sees and is discounted and pay a premium interest cost for doing so.
Well, the reason I would prefer to hold until Thursday is I think I would like Secretary Brady to make his presentation of the full detail of his program before I discuss some of the detail.
Well, I won't press that issue now, but I hope it's clear on its face that if we resort to any financing mechanism that in effect is a gimmick that drives up the interest rate no matter how many basis points, and in turn ends up obligating the government in the future, which is all the taxpayers of the country, to pay extra money to solve this problem, I think you've got to have a very compelling rationale for why that's being done. And what I've heard today, the general thrust of what you have said is that the need to reduce the deficit is so critical that we ought to be honest about what we're doing, and we should not squander money in any way, including premium interest rates, because we resort to some sort of a financing sidestep here. So I think it's a very important issue, and it does have some relevance today. Let me go back to something else you said earlier, and that is you were citing the unique buildup of circumstances that you find today from your position. We see it here from this committee's position, with your description of a crisis in the thrift industry, the significant rise in the ratio of debt to equity out in our private sector structure, the large continuing trade and central government deficits, the fact that the expansion has gone on for historically now a very long period of time. And you created, in that description earlier, a picture of a set of elements here that are ones that are unique and that really pose some dangers to us if we don't deal with them directly. I think you clearly felt that way and conveyed that impression. And I'm inclined to agree with you. I think as we look at all these things, the LBOs and everything else, we're in an unprecedented situation, and the time to act is now. We're in the beginning of a new administration. There's a new Congress. If we all step up to the responsibility of acting, presumably we can put a strategy in place that starts to adjust us through this whole set of problems. But I say all that by getting to this question. When you've lived a long time in the world of national and international finance, and you add them up in terms of the kind of threat or risk they present to us if left unresolved, how serious a mixture of problems is this? I mean, I think the Congress needs to understand, the public needs to understand exactly the dimension of the risk. Some people say there is no risk, that they're tough, difficult, unpleasant problems, but one way or another we'll work our way through them. And I'm asking you, from your vantage point, if you take them all together, the point of time where we are now, how urgent is it that we act on these things? Do these, in combination, constitute something that would be an 8 on a scale of 1 to 10 in terms of the overall urgency and risk that they present to us? Or are we talking about something that's down in the 5 range or a 3 range, or where are we exactly?
Well, the truth of the matter is, Mr. Chairman,
in your judgment,
no one really knows and can't know. I mean, we're dealing with degrees of complexity that anyone who gives you a definitive answer to that question is expressing a degree of ignorance, not insight. It's clear that there are sufficient latent or potential risks, or in fact, as one evaluates the various different things, that there is enough of a concern that the risk could be large, that it very significantly skews policy towards reducing the budget deficit and making certain that inflation does not accelerate and create very significant additional imbalances in the system. So I think that the reason I addressed the issue, the question that Senator Worth raised earlier in the way in which I did, is that what we have got is a rather complex structure of problems, and what we cannot expect to impose on them is a renewal of inflation and expect that they will somehow unbalance. They won't. That we know with a high degree of assurance. How the other elements in the financial structure, the debt question, the trade deficit, a variety of other subsidiary types of problems, including the thrift issues, how they all come out is difficult to say, but we do have the capability of pulling them all off. I mean, it is not, one shot in 20. We've got a much higher probability of doing that. We can resolve the LDC issue.
If I may just interrupt there, I agree with you that we can solve them. I think we can as well, but I'm really asking you to reflect on a different question here, and that is that we might very well not resolve them because they're very difficult to resolve. I think we've been sidestepping the budget deficit, using the Social Security surpluses as an out. We still are. I'll come back to that a little bit later. It's very easy to sidestep one or more of these problems. And I think it's very important, if you feel it's important, that the risks are so large if you let this buildup of situations just run and just sort of drift along without some very serious resolution of these problems, that we may be facing risks of a dimension that we have not seen in a long period of time. And if you feel that way, now's a good time to let everybody know it, because we're going to have to start making decisions around here. And if we can be more sanguine, then I think there'll be a lot of people that will decide to be sanguine.
Well,
despite how you and I might feel about it.
Yeah, I think that what I don't want to convey to you is more than I know. I'm not saying, in effect, that we have to resolve the budget deficit issue within the next 6 weeks or 2 weeks or 2 years. I don't know the answer to that. What I do know, however, is that the longer we wait to resolve it, the greater the risks to the system. And what I'm saying is that the size of the problems that could happen if we fail to address these problems appropriately is of such an order of magnitude that we should not, as a nation, take them. So,
What are those risks?
well, the risks basically, let's assume that we do not resolve the budget deficit question. I would say we can have a significant acceleration of inflation in this country and a very considerable set of imbalances which would lead to a major contraction. So, I mean, but the question which I cannot answer is, does that mean that we have to resolve it immediately? I don't think so. I do think we have a little time, but I don't think we have time to procrastinate and hope it will all go away, because I don't believe it will go away.
Mr. Chairman.
I must say, I am somewhat optimistic, knowing the players, that it will get resolved. But I am saying that we cannot take the chance of not resolving this question.
When you say some period of time, I gather you're thinking in terms of months and not years.
Well, I mean, I cannot say to you that if this thing drags on and we eventually resolve it sometime early next year, that that's too late. I frankly don't know. I would feel uncomfortable about doing that, but I don't know enough, nor does anybody have the knowledge to make that judgment.
I'm not asking for precision, because as you say, none of us have it. But you know, you come as a person with very highly respected professional judgment, and you're probably in as good a position to make an overall professional judgment as any person we might ask. So I think, given that, I think it's a fair question to ask in terms of the degree of risk we run here if we should not step up to these things and resolve them in some rather decisive way.
I would say the degree of risk of allowing this whole process to fester is unacceptable.
Senator Presser, you wanted to
Yes, well, I just
be
wanted to
recognized.
get in that because I agree with you that it is such a severe problem. But I see us going through the same cycle up here as we've gone through, and I've been here for 14 years. Somehow, and I say this with a backdrop of just having returned from going all over my state, somehow we need a presidential speech on where to make the cuts or what to do about this budget deficit. Or we need some kind of national position by people such as yourself, or because each member of Congress I can give a speech in my hometown and 100 people will listen to me, and I've got a plan, which I won't go into here, but the point is, by the time we get through, but I would like to embrace a presidential plan or something of that sort. But we really haven't had that explained to the American people. Everybody tells Congress, you've got to cut the budget. Okay, well, we all agree. Everybody agrees we've got to have a balanced budget. We all agree. But we haven't really, somewhere I think we're crying out for a national focus of somebody who can explain this thing, rally support nationwide, and so forth. It seems that everybody's kind of passing the buck to everybody else. That's what is the tragedy of the current situation, as far as I can see it. Is my analysis correct, or would you disagree with that?
I'm a good deal more optimistic than you, Senator. I think that this country, when it comes up to the necessity to do something, has historically done it. And while I can sort of abstractly discuss the various different outcomes if we don't do anything, I frankly, honestly don't believe it's going to come out that way. I do think that we understand what has to be done, and it's not that great a change. I mean, some less developed countries, many of them, have undergone types of adjustments far greater than any that we have to go through. So I must say to you, I understand all the problems, but I'm not really, I can't honestly tell you, I think we won't resolve them, because I really believe that we will. I think we'll make a good deal of political negotiation and friction, but in the end, I'm reasonably certain that we will all come together with an appropriate policy.
Senator Pressler, you're next in the order, and then I'm going to go to Senator Graham.
I've asked my questions.
Senator Graham.
I would just like to add to the comments that have been made by the chairman and Senator Pressler. I agree that the president has an opportunity and I think a national responsibility to be specific as to where he thinks our federal fiscal policy should go. For example, there is tremendous concern among Americans in the age group 25 to 40 as to whether some of the basic support systems such as Social Security and Medicare are credible for them. I believe that part of solving the budget deficit is to give some degree of assurance to Americans as to basic federal financial commitment to programs upon which people are basing a substantial amount of their lifetime planning. Early in the President Reagan administration, there was a lot of discussion about the issue of new federalism, a sorting out of domestic responsibilities among levels of government. I think that there was a great deal of wisdom in that effort which has sort of dissipated. I believe those are two areas in which presidential leadership on more than just that we need to reduce the budget, but what are some longer-term objectives in reducing the budget would be very positive and would help to build a national coalition behind the tough decisions that the chairman has indicated we'll have to make. If I could move to another subject that we've already discussed somewhat, and that is the capital gains issue. On page 11 of your statement, there's a paragraph which indicates your basic support for capital gains reduction, and I appreciate the further amplification that you've given. Assuming that the overall budget issue is such that that is a matter that could be seriously considered, what would be your recommendation as to the shape of a capital gains policy?
Well, I thought the President's proposal is a sensible proposal. In other words, it's a good way of structuring proposal, and I think that if it were enacted, I think it would have positive effects. I mean, there are numbers of different ways in which one can alter the capital gains tax, but I thought that that proposal was a sensible one.
Well, let me ask, would you favor a longer holding period than the 6 months which was applicable when we last had capital gains? And if so, would you favor a tiered holding period where greater tax benefits accrued to longer periods of ownership?
Depends on the rate, Senator. In general, I would have some sympathy for that sort of proposal.
Do you have any suggestions as to what the relationship of rate to holding period might be, or how you would go about thinking through reaching the numerical answer?
Senator Wright, years ago I studied the issue in great detail and had very specific conclusions with respect to that question, but I've not been in touch with the numbers to a degree in the last several years which I would feel comfortable in giving you such a response.
Thank you, Mr. Chairman.
Thank you, Senator Graham. Just a few other things to cover, Chairman Greenspan, today. We've been talking about meeting the Graham-Rudman-Hollings targets, and there's some of us who feel that's an honest discipline. Some of us feel it's an inherently dishonest accounting discipline the way we do it. One of the facts that is implicit in how we do the calculation is that this year, for the fiscal year that we're now doing the budget for, we're going to borrow $68 billion from Social Security. The regular general government is going to borrow $68 billion out of Social Security, give the Social Security Fund a series of IOUs, and we're going to spend the money on the day-to-day operations of government. Some of it goes to the Defense Department, some of it goes to the FBI, some of it goes to the drug war, and so forth, and it'll be spent. And the general government, in effect, will then owe the Social Security that money that it's borrowed and have to pay it back sometime in the future. As I track this through in my own mind, it seems to me what's happening here is that individuals who are paying in their Social Security taxes each day, as I do and as you do, are finding that the money that they're putting in that's supposed to be there to pay their retirement benefits in the future is being borrowed, taken over into the general area of government, being spent every day as part of the way to make the deficit look lower than it really is. And in the future, that money is all going to have to be replaced. It's got to come from somewhere. It's got to be put back into the general government and then sent back over to Social Security to pay those benefits in the future when it's time for people to receive them. And it seems to me that, in effect, people are going to find themselves paying twice. They're paying now, the money's being borrowed and spent. In the future, they're going to be asked to put money in to repay the IOUs to come back over so that they can receive their Social Security benefits. Now, the actual operating deficit of the budget is about $250 billion at the present time. If you take out the Social Security surplus use and the other trust fund surpluses, how can we continue to do that? I mean, we say one thing in terms of what the deficit figure is, but in cold point of fact, the real operating deficit is about $100 billion larger. Now, the financial markets of the world just accept this, take this in stride, this accounting trick, and they're quite comfortable with it, and we can just do this indefinitely?
I think what the financial markets do is to recognize that there really is a single federal government deficit, what we call the unified budget deficit, and that the issue of various trust funds are merely assumed to be consolidated in the system and essentially involved with intra-governmental transfers. If we wish to create a significant amount of savings and therefore investment, real investment, which generated the incomes or generated an increased degree of productivity, which therefore created the sum or the fund from which, in real terms, Social Security beneficiaries were paid off, then I think we would have to deal with the Social Security Trust Fund as though it were a separate organization investing in private instruments and, in a sense, independent of the, as you put it, the operating budget. The crucial issue, however, is that when one looks at the question of the effect of the overall government, both Social Security and all other, the crucial issue on the savings of the the effect on the on U.S. savings total, the crucial thing is the unified deficit, because if the total budget, the unified budget, goes into surplus because the Social Security surplus is larger than the operating deficit, that creates an increase in total domestic savings for the United States, which is, in my judgment, the crucial long-term problem.
Well, but let me ask you this. That's precisely what the Social Security fund is supposed to be. It's supposed to be a savings fund, and that you put the money aside, you invest it, presumably in earning assets, and so the capital is safe, the earnings build up, and the money is there to pay benefits in the future. You collect that tax for a dedicated purpose, and we know precisely what that purpose is in the future. If you just take that money in the meantime and spend it on the daily operations of government, and that's what we're doing now, and we're going to take and spend $68 billion, and we're just going to chew it up. It's going to go out for every single thing the federal government does each day. I don't really understand how you can justify that. I mean, could we borrow any conceivable amount, or would you be on trouble if when the surpluses get up to, say, $200 billion a year, we take it all, spend it on the daily operations of government, and feel that somehow or another we're not putting ourselves in a terrific problem for the future?
Well, actually, in a certain sense, Mr. Chairman, the problem's even worse than that, because to the extent that special instruments, that is, special issues, are issued by the Treasury to the Social Security Administration, interest is paid on that. And that interest becomes a very large number. My recollection is that at the turn of the century, in the late 1990s, the early 2000s, that the intra-governmental interest payment from the Treasury to the Social Security Trust Fund is about 1% of the GNP, which is a very large number. It's the equivalent of 50 billion today. That means that the outlays for the non-Social Security part of the budget must include those interest payments to the Social Security Trust Fund, and a goodly part, a substantial part of the very large building surplus that we calculate for the Social Security Trust Fund reflects the buildup of intra-governmental interest payments. So when we see in our calculations that on the one hand, Social Security surpluses, annual surpluses, are going up like that, non-Social Security deficits are going up like that, because both are very significantly affected by the same number, which when we consolidate the accounts into the unified budget, wash out as intra-governmental transfers, and we never see it.
But don't you think the time has come for us to stop using the Social Security surpluses as a way to borrowing them and spending them on the daily operations of government in order to make the deficit look smaller than it really is? Shouldn't we really stop that kind of practice and really get down to the hard job of dealing with the true inflows and outflows in the general government?
Well, I don't disagree that it would be useful to do that, but there is an important distinction in that the unified budget does have a certain meaning, and I think it is a useful concept, because even though it is even though you segregate Social Security, and even were you to invest the proceeds in private instruments, combining the two is the measure of what the government is doing to savings.
I don't argue with that, but when you bring it back over to measure the operating deficit of the government, and we've got all this intense focus on the federal budget operating deficit, you've talked about it today, we've got the whole Graham-Rudman discipline around it, which I think is not an honest discipline, partly for the reason I've just described. But the cold fact of the matter is that we're running a much bigger operating deficit today than anybody wants to admit, and we're hiding the deficit by borrowing all the Social Security money and spending it to reduce the posted size of the deficit. And you talk about the size of the interest claims in the future being enormous, and they will be, all of which presumably are going to have to be paid by taxpayers. This is part of the paying twice problem. But the interest payments are a small fraction of repaying the principal. I mean, we're actually spending the principal each day. I mean, that's what's being, I mean, you're nodding in the affirmative. I want to make sure that that shows up on the record, but we're consuming the principal each day. And that's the thing that is a brand new condition. We have not had that before the last 2 or 3 years, because we have not been running these large surpluses in the Social Security Fund. But what has happened here, it seems to me, is that we're engaging in an accounting trick. We're going over and borrowing it, and we're using it to make it appear as if we're reaching these Graham-Rudman targets on an operating basis, when in fact we're not. We're off by about $100 billion. And I gather the markets, by and large, have figured all this out. They're at peace with it because they've got this rationale that you say, and that is, if you take a broad economic view, it doesn't really matter, in a sense, whether you're burning up the money today and won't have it to pay the bills when they come due in the future. But I really think it's dishonest, and I think it's one of the issues that we ought to be facing right now in the first half of 1989, and I see a sidestep. I don't say by you, but I see a sidestep going on in that area, because we've got a comfortable way to basically make it appear that we're hitting the Graham-Rudman-Hollings targets, when in fact we're not without, in a sense, looting the Social Security reserves and spending them each day on other purposes, which is exactly the way we're meeting the so-called Graham-Rudman targets. It's very frustrating to see that, because when you throw that back in on top of your list, crisis in the thrift industry, the significant rise in ratio of debt to equity, the large trade and central budget deficit, I'm just quoting from your comments as I wrote them down as you made them earlier, It seems to me that the time to be very hard-boiled about it is right now. And you're, I'm going to yield to Senator Graham, but you're the person, we're all in the hot seat, but you're in a very special hot seat because you have to try to make monetary policy work as the last resort to reconcile all the irreconcilable policy conflicts. And it can't be done. No matter how skillful you may be, and you work as hard as anybody, and I have great confidence in your ability, you can't reconcile the unreconcilable any more than somebody else might be able to. So coming back and getting the lever underneath the policy changes that are needed and to talk about it with a sufficient degree of urgency, I just think is the order of the day. If we miss this chance, I think you may find yourself out there trying to manage a puzzle that increasingly is unmanageable. And I don't want to see that happen. I don't want to see that happen to the country. I don't want to see us in that situation of risk. But it seems to me that you made a case here in an understated way today that all of these pile-up of difficulties have taken us to a level of risk that if we don't face them honestly and start to resolve them quite quickly, not tomorrow morning, but on an accelerated time frame here, we run risks that we haven't seen, maybe since the 30s. I mean, that's my interpretation of what I think I hear you saying today.
I am concerned, Mr. Chairman, but as I said earlier, I have enough confidence in the way our system functions to believe we will resolve these difficult questions as we have resolved questions in the past, and I think that the willingness of the Congress to address this issue as expeditiously as apparently it is, and the seriousness of purpose which I infer from the attitude of the President and the key members relevant to this whole process of both thrift problems and budget deficit problems, to take two major issues, I must say gives me a degree of confidence that we will come out in a manner which will be the type of resolution which will make the system, will make a restoration of balance in the system something which is quite achievable.
Well, we're going to work with you to accomplish that in every way we can, and you've seen some of that, and you'll see more as we go through this S&L problem later in the week. I'm going to raise one other thing and then yield to Senator Graham, and that is this. The finance minister of Germany, of West Germany, is quoted by Reuters on the 16th of February as saying that the U.S. Federal Reserve now estimates U.S. 1989 inflation at 6% rather than 5%. And he went on to note that inflation was pressing up in other countries. In Britain it was 7%, and in Italy it was approaching 6%, and in fact he was noting an increase in inflationary pressures in West Germany. Where does that figure of 6% that he cites as being attributable to our Federal Reserve come from?
I frankly don't know, Mr. Chairman. It's possible that I may have inadvertently misspoke in conversations with him, or one of my colleagues may have. It is not an official figure, nor is it any figure that we have internally in our staff operation. So it's likely that I or one of my colleagues misspoke and didn't get corrected in the process of what our internal forecast structure is. But
So
that is not our forecast.
So there is no spoken or unspoken expectation within the Fed that we're looking at inflation of 6%, and that's being conveyed to foreign ministers around the country, around the world.
It certainly has not been conveyed in any sense that I'm aware of, other than by somebody misspeaking, because it's not factually the case.
So that is not the internal view within the Federal Reserve in terms of the inflation expectation?
It is not.
Thank you. Senator Graham?
Mr. Chairman, I have no further questions. I appreciate the excellent testimony of the chairman, and hope that in the near future that you will get some political support to match the monetary leadership that you've been giving.
Thank you very much, Senator.
Chairman Greenspan, we thank you very much. You've been very patient and forthcoming as always, and we appreciate your testimony. Committee stands in recess.